Free lunch here at Zacks. I'm your host, Ben Rains. Stocks around the world fell on Thursday as worries about the coronavirus continue to spread. The Shanghai Composite Index slipped 2.8%, which marked its biggest drop in months, on the last day of trading before the market closes for the Lunar New Year holiday period. On Thursday, the Chinese government locked down the Wuhan area where the new virus began. Officials then locked down 2 other cities, which impact millions of people in an effort to contain the spread. So far, at least 17 people have died and over 500 have been infected. On a lighter note, U.S. home sales jumped to their highest level of the year in December, up 3.6% over November. This comes amid low mortgage rates and historically low unemployment. 2019's existing home sales matched 2018 at 5.3 million, and the second half push could spell good news for home buying market in 2020. It is worth noting that inventory remains tight. However, U.S. housing starts hit a 13-year high in December. Plus, the National Association of Home Builders said that home builder sentiment last month was higher than it has been at any month since 1999. Now we move on to the earnings-heavy portion of the show. Both Southwest and American Airlines reported their quarterly results before the opening bell. Southwest fell short of our Q4 estimates, while American matched. But Wall Street seems more focused on the continued grounding of Boeing 737 MAXs and how it will continue to impact the airlines. Southwest's CEO Gary Kelly said Thursday it will likely have to delay its plans for the MAX to return to service in June. Plus, both airlines said they continue to talk with Boeing about compensation for their growing costs. Meanwhile, Procter & Gamble topped our quarterly earnings estimates, and its sales climbed 5%, which did fall slightly short of our estimates. PG stock dipped in morning trading, but the stock is still up 33% over the past year to outpace its industry's 21% climb. Meanwhile, Procter & Gamble rival Kimberly-Clark topped our Q4 estimates, but the stock still dipped. On top of that, Comcast stock climbed to new highs in pre-market trading, but then slipped around 3% through morning trading. Comcast topped our Q4 earnings and revenue estimates. The cable and internet giant also raised its dividend by 10% for the second year in a row. Comcast sales climbed 2% even as it lost more pay TV customers for the 11th straight quarter amid the cord-cutting age. The firm lost 149,000 pay TV customers, but it added 442,000 high-speed internet customers. And last week, Comcast's NBC Universal leg announced detailed plans for its streaming TV platform. The company hopes Peacock will be able to compete alongside the likes of Netflix, Disney, and others. Intel reports after the closing bell Thursday, and our estimates call for the tech firm's adjusted earnings to slip just over 3%, while revenues are set to pop 2.9%. Intel has a solid history of quarterly earnings beats, including big bottom-line beats in the trailing 2 periods. Peeking ahead to next week, we have reports due out from Apple, Microsoft, Facebook, Amazon, and many other giants as Q4 earnings season continues to heat up. And that does it for the news portion of Free Lunch, but stick around for today's new Zacks Rank #1 Strong Buy stock. back to Free Lunch. Today we're breaking down why Pure Storage is a Zacks Rank #1 strong buy stock. Pure Storage is an enterprise data storage and solutions firm that has crushed our bottom line estimates recently. The tech stock is also trading at under $20 per share, which might make it attractive to investors looking for a quote, cheaper growth focused play. So let's jump right in. As always, I'd like to start with just a quick look at the company's website. It's pretty straightforward. They're working in that cloud space, Pure Storage. You don't need to know that much more, and obviously any interested investors can dive a lot further into this on their own. So now we're going to go ahead and just take a look at what the company has done recently in terms of its stock price movement. So the ticker, which is PSTG, the stock's up about 11% so far in 2020, which outpaces its industry's 7% climb. We can also see that comes in well above the S&P 500's growth over this stretch. So if we look over the last 5 years since the company's been a public firm, it's been a little more choppy, to say the least. So you could say that it might be more of a trader stock or something that's not necessarily a longer term play at the moment, but it did have an impressive run from this is the very start of 2017 all the way up until when the market slowly started to fall in the fall of 2018, and it's been a little choppy since then. But if we look, it fell despite an earnings beat in November, but over the last month or so, things have started to pick back up. So it's headed in the right direction, and we'll quickly look at the company's growth in terms of top line growth to give people a sense of where it's going. So about 33% growth the year before that, and 38% growth in their fiscal 2018. They're currently in their fiscal 2020. So now we're going to go ahead and look at what our estimates are calling for. So we'll see a little bit of revenue slowdown. Obviously, that's going to be a function of companies as they grow. The revenue growth in terms of percentages is going to be harder and harder to come by. So we're still calling for about 21% growth this year, up to $1.64 billion, and then another 19% growth in fiscal 2021 to get almost up to that $2 billion mark. And then if we look at the bottom line, this is where the growth looks even more impressive. So we're calling for 19% growth in their current fiscal year of 2020, and then nearly 60% growth on top of that for fiscal 2021, all the way up to 40 cents per share on an annualized basis. And then if we look over as I mentioned, the last several periods, the company has crushed our bottom line estimates. So 44% and 125% beat. When we were calling for a loss, they posted positive earnings. And then if we go up to the top, you'll see that this stock is trading. This is the last price we have quoted at under $20 per share, at about $19 per share. So it's certainly a cheaper one of these tech plays in a growing industry, this cloud space and data storage and that industry in general. And we see that it has an A grade for growth, and it is, as we mentioned again, a #1 strong buy at the moment. So Pure Storage is clearly part of a larger growth industry within the tech space, and it's trading at a discount compared to its industry in terms of forward sales. And as we mentioned multiple times, it's trading at that under $20 threshold, which is attractive to some investors. Therefore, the stock appears to be worth considering at the moment. And that does it for today's episode of Free Lunch. Make sure to also check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. Also, make sure to tune into Paper Traders, which is live at 11 a.m. on Wednesdays. Once again, I'm your host, Ben Rains, and we'll be back next time with more up-to-date market news and a new top stock pick.